You have $1,000, you want to invest it, but every article you read gives you a different answer. Index funds, ETFs, real estate, crypto, and you end up doing nothing. This video is the one that ends that. By the end, you'll know exactly where to put your first $1,000, step by step, no fluff. Before we get into the steps, let's kill two myths right now. Myth 1, you need more money before you can invest. You don't. $1,000 is enough to start building real wealth. Myth 2, investing is complicated. It doesn't have to be. The most effective investment strategy in the world fits in a single sentence. We'll get there in step 3. Here's what we're covering today. First, the one thing you must do before investing a single dollar. Second, how to pick the right account. Third, exactly what to buy. And fourth, what to do after you hit invest. Let's go. Step 1, clear the runway. First, before you invest a single dollar, you need to answer one question. Do you have high interest debt? Anything above 7% interest, credit cards, personal loans, is a guaranteed negative return on your money. Paying off a 22% credit card is mathematically identical to earning a 22% investment return. Warren Buffett doesn't get 22%. You do by paying it off. Here's the simple rule. If your debt is above 7%, pay it off first. If it's below 7%, like a mortgage or student loan, invest while making your minimum payments. If you have no high interest debt, congratulations, you're ready. Let's pick your account. Step 2, pick the right account. Where you invest matters almost as much as what you invest in, because the government can take a huge cut if you pick the wrong account. Let's cover your 3 options in order of priority. Number 1, the 401k with employer match. Do this first, always. If your employer matches 4%, contribute at least 4%. That's a 100% return before the market does anything. Free money, never leave it on the table. Number 2, the Roth IRA. For most people, this is the best next move. You pay taxes now, but every dollar it grows, you never pay taxes on again. If you're in your 30s, this could save you 6 figures in retirement taxes. And that's not a typo, 6 figures. Number 3, a taxable brokerage account. Use this if you've already maxed out the first 2. No contribution limits, full flexibility, but no tax advantage. This is also where you'd invest for goals before retirement age. A house down payment, starting a business, anything you want to access before 59 and a half. I'll put links to open a brokerage account in the description. It takes about 10 minutes. Step 3, what to actually buy. Remember that strategy that beats 87% of professionals? Here it is. Buy a low-cost index fund that tracks the entire US stock market and hold it forever. That's it. A single fund like VTI or FSKAX gives you ownership of over 3,500 companies. Apple, Microsoft, Amazon, thousands of others in one purchase for basically 0 fees. So here's exactly what to do with your $1,000. If you're using a Roth IRA, put it all in VTI or FSKAX. Don't split it up. Don't try to be clever. One fund. If you have no 401k match and no Roth IRA yet, open a Roth IRA today. It takes 10 minutes. And buy VTI with the full 1,000. You're now an investor. Now I know what you're thinking. What about individual stocks? What about real estate? What about crypto? Those are all valid options once you've built a foundation. But your first $1,000 isn't the time to gamble. It's the time to build a habit and a base. We'll do a whole video on what comes after this. Step 4, after you hit invest, you've invested your first $1,000. Now the most important thing you can do is almost nothing. Don't check it daily. Don't sell when the market drops. Whack and it will drop. The market loses 10% or more in a given year about 1/3 of the time. That's normal. That's the price of admission for 10% average annual returns. 3 things to do now. First, turn on auto invest. Set up a recurring contribution, even $50 a month. Automate it so it happens without willpower. Set it and forget it is not lazy, it's optimal. Second, don't look at it more than once a month. Studies show investors who check their portfolios less frequently actually earn higher returns because they're less likely to panic sell. Your biggest enemy isn't the market, it's yourself. Third, keep adding. The first $1,000 is the hardest, The second is easier. Put $200 a month in for 30 years at 8% average returns, and you end up with nearly $300,000 from $200 a month. The investment isn't the money, it's the habit. Let's recap. Step 1, kill high interest debt above 7% first. Step 2, open the right account, 401k match first, then Roth IRA, then taxable brokerage. Step 3, buy a single low-cost index fund like VTI. Step 4, automate it and let time do the work. That's it. That's the whole playbook. You don't need to be smarter than Wall Street, you just need to start. If this helped, subscribe. I post exactly this kind of no-fluff money content every week and drop your biggest money question in the comments. Your question might be the next video. Now go invest that $1,000. There's a sentence that has cost millions of people hundreds of thousands of dollars, and there's a good chance you've said it yourself. I'll start investing when I have more money. It sounds responsible. It sounds like you're being realistic, but it's one of the most expensive things you will ever say. And today I'm going to show you the math that proves it. Because once you see these numbers, you can never unsee them. Here's the thing about waiting. It feels safe. When you tell yourself, I'll invest later, when things are more stable, when I have more breathing room, you feel like you're being smart, cautious, responsible. But what you're actually doing is making a decision. You're deciding right now to give up one of the most powerful forces in personal finance, and that force is time. Time in the market is worth more than the amount of money you put in. Let me say that again. Time in the market is worth more than the amount of money you put in. That's not motivation talk. That's compound interest. And in a minute, I'm going to show you exactly what that costs in real dollars. But first, let's talk about what more money actually means. The more money myth. When people say they'll invest when they have more money, I always ask, how much more? And they never have an answer. Because more money isn't a number, it's a feeling. And that feeling moves. Every time you get a raise, more money shifts just out of reach. Every time a big expense comes up, a car repair, a medical bill, a vacation, you reset the clock. Next month, you say. Next quarter. After the holidays. This isn't a budgeting problem, it's a psychological one. The goalpost keeps moving because you never set a fixed target in the first place. And while you're waiting, the market is running without you. The real cost of waiting, the numbers, let me give you two people. Both are 28 years old, both have the same income. Person A starts investing $200 a month today. That's it, $200. Less than most people spend on subscriptions and takeout combined. Person B waits 5 years until they're 33 to start. And to make up for lost time, they invest $400 a month, double the amount. Both invest until they're 65. Both earn an average 8% annual return. Here's what happens. Person A, $200 a month starting at 28, ends up with $702,000. Person B, $400 a month starting at 33, ends up with $644,000. Person B invested twice as much money every single month, and they still end up with $58,000 less. That is the cost of waiting 5 years, $58,000 even when you try to catch up. That is time doing its work, or in this case, not doing its work, because you didn't give it the chance. But I only have $50 a month. I hear this all the time, and I want to address it directly. $50 a month feels like nothing. It feels like it's not even worth the effort of setting up an account. But let's run the math on that too. $50 a month invested from age 28 to 65 at 8% average returns. That's $175,000 from $50 a month. The money isn't the point. Starting is the point. Because once you start, two things happen that don't happen when you're waiting. First, you build the habit, and habits scale. The person investing $50 today is far more likely to increase that to $100 than $200 than the person still sitting on the sideline waiting to feel ready. Second, your money starts working immediately. Every single month you wait is a month your money isn't compounding. And in the later years of that curve, each month is worth more than the month before it. The last decade of compound growth is the most powerful. You don't want to shorten it. The I'll wait for the right time version, some of you aren't waiting for more money. You're waiting for the right moment in the market. You're watching the news, seeing volatility, and thinking, I'll wait until things calm down. I'll buy when the market dips. Here's what the data actually shows. A study looked at what would have happened if you tried to perfectly time the market versus just investing on the first day of every year, no matter what. The perfect timer, someone who always bought at the exact lowest point, ended up with just 15% more than the person who simply invested consistently without trying to time anything. 15% after a lifetime of perfect decisions, and nobody gets perfect decisions, so the gap in real life is basically zero. Time in the market always beats timing the market. Always. The objection, I haven't addressed yet, but I have debt. I can't invest while I'm paying off debt. Fair question. Here's the honest answer. If your debt has an interest rate above 7%, credit cards, personal loans, pay that off first. A guaranteed 22% return from paying off a credit card beats any investment. But if your debt is below 7%, a mortgage, federal student loans, you should be doing both. Pay your minimums and invest at the same time, because the market's average return over time is higher than that interest rate, and every year you wait to invest is a year of growth you never get back. Don't let below 7% debt be the excuse. That one costs you more in the long run than the interest ever would. The only question that matters, here's what I want you to sit with after this video. Not how much should I invest? Not what should I buy? Those questions matter, and we cover them in other videos. But the only question that matters right now is this. What am I actually waiting for? Write it down. Get specific. Because if your answer is more money, now you know that more money invested later is worth less than less money invested now. The math doesn't care about your comfort level. It only cares about time. And every day you wait, you're spending time. The one thing you cannot buy back. The start. Here's what I want you to do after this video. Open a Roth IRA or a brokerage account today, not this weekend. Today. It takes 10 minutes. Links are in the description. Set up a recurring investment of whatever you can actually afford right now, not what you think you should invest, what you can do today. Even if that's $25, even if that's $50, and then don't touch it. That's it. You're not waiting for more money anymore. You're in the market, and from this point forward, time is working for you instead of against you. If this hit different, subscribe. Every week I put out exactly this kind of straight talking, no fluff money content built for people who are done making excuses and ready to actually build wealth. Drop a comment below. How much are you starting with? I read every single one. Let's build.